There was a historic breakthrough in China this April. In the first half of April, sales of traditional internal combustion engine cars fell below 50% in all new car sales. In other words, new energy vehicle sales exceeded 50%. This is a breakthrough. So when prices fluctuate at this juncture, or a price war as you call it, it's normal. We foresee that for a long time down the road, price volatility will be relatively big. For NIO, we hope to keep the pricing of our brands stable.
Comeback, challenges, and opportunities. If you've been following NIO, you know it's a big player in the EV market, but its stock has taken a huge hit, dropping over 41.2% this year and more than 92% from its peak in 2021. In this video, we'll dive into what's going on with NIO, its challenges, and its potential for a big comeback. Will NIO bounce back, or is more trouble ahead?
So NIO definitely has a significant amount of market share, but once again, they're just not up to the production level yet to turn consistent profitability here in the near term.
NIO has had a rough few years in the stock market with a significant drop in share price. This downturn reflects broader challenges in the saturated electric vehicle industry, where over 100 companies are vying for market share. To stay competitive, NIO, like many others, has had to cut vehicle prices, negatively impacting profit margins. This price-cutting trend is expected to continue until market conditions stabilize and vehicle prices begin to rise again. Further complicating matters, there's growing concern that China may oversaturate the vehicle market as it did previously with steel and solar energy. This has led to a competitive disadvantage for many countries trying to keep up in these industries. Recently, geopolitical tensions have escalated, with President Joe Biden announcing a hefty 105% tariff on Chinese EVs, a move likely to provoke similar actions from Europe. The US and Europe have criticized China for what they consider unfair competition practices, including substantial government subsidies to the EV sector. In response, China has criticized these regions for their deindustrialization efforts and heavy military spending. Despite these challenges, NIO shows signs of resilience. The company reported a 6.5% increase in revenue in the fourth quarter, reaching $2.4 billion, with a gross profit margin of 7%. Looking beyond traditional markets, NIO and other Chinese EV makers are targeting regions like Russia, where Western brands have retreated, and the Middle East, currently the fastest-growing market for EVs. Notably, a significant investment from a UAE entity in 2023 has bolstered NIO's position in these emerging markets.
A mass market brand that they're going to be putting to market soon?
Well, yes, they have a brand strategy to broaden their brand portfolio. NIO was launched as a more premium offer with a services-oriented business model, which is why they spent so much in battery swapping and in NIO House. So that spread a lot of their capex out, a much higher burden and more burdensome business model than a typical automotive company. But they do have a strategy to diversify the brand portfolio. There are 2 brands coming. Speaking
of expansion, NIO recently made waves in the electric vehicle market by introducing its new, budget-friendly onvo brand. The launch of the onvo L60 SUV aims to directly challenge Tesla's Model Y SUV and Toyota's RAV4. Priced at $30,476, the onvo L60 is positioned as a cost-effective alternative to its namesake lineup, starting at about 12% less than the Model Y. Moreover, it boasts enhanced spaciousness and efficiency, utilizing 10% fewer materials compared to Tesla's offering. NIO's chief executive, William Li, emphasized the company's commitment to redefining family car standards, highlighting advancements in smart EV technology. The onvo L60 is equipped with NIO's proprietary 900-volt fast-charging engine system, offering improved energy consumption at 12.1 kilowatt-hours per 100 kilometers, slightly more efficient than the Model Y. Despite the promising product launch, NIO stock faces challenges, with a 37% year-to-date decline amid the broader EV market slump. However, not all analysts are bearish on NIO, as investment banking giant JP Morgan recently upgraded its rating to neutral from underweight. Analysts cite potential benefits from changes in China's EV policy favoring increased EV usage. Nonetheless, NIO must navigate significant obstacles, including an anti-subsidy probe by the European Union and the imposition of 100% tariffs in the US. Revolutionary, milestone, and advantage. NIO has also been named a leader in battery technology with the introduction of its 150 kilowatt-hour semi-solid-state battery pack, developed in partnership with WeLion. This significant advancement places NIO among the first automakers to integrate this next-generation technology into production vehicles. Initially unveiled for the ES6 SUV, the semi-solid-state battery offers high energy density, promising a substantial increase in driving range. Early projections suggested a range of over 620 miles on a single charge, though current figures estimate a more realistic range of around 578 miles. Following a period of development, NIO has started incorporating this solid-state technology across its lineup. They have filed documentation with China's Ministry of Industry and Information Technology, detailing plans to equip several existing electric vehicle models with these advanced battery packs from WeLion. The 150 kilowatt-hour semi-solid-state battery provides several advantages over traditional lithium-ion batteries, including greater range, improved safety, and faster charging times. Competitors such as Tesla, Volkswagen, and Toyota are also researching and developing solid-state batteries, indicating that this technology could dominate the EV market in the coming years. NIO's partnership with WeLion marks a pivotal step towards mass production of solid-state batteries, which could significantly reshape the EV industry by offering drivers enhanced performance and efficiency. This innovative approach to battery upgrades sets NIO apart in the EV market, offering a significant advantage for both the company and its customers. As the technology matures, it holds the potential to revolutionize the EV industry, making electric vehicles more efficient, safer, and more convenient for everyday use. Upgrade, challenges, and potential. As for NIO stock, there's some good news for shareholders. JP Morgan, which had a sell rating on NIO for the past 3 months, has now upgraded the stock to neutral. The investment bank has set a price target of $5.40 per share, implying a slight upside from the current price of $5.32. However, this doesn't mean they consider NIO a buy. NIO, currently valued at $12 billion, had a rough year, losing nearly 25% of its market cap. The company is burning through its $2.1 billion in net cash at an alarming rate of $2.2 billion per year. Analysts expect this cash burn to increase to $2.3 billion this year due to the intense price competition among Chinese electric vehicle manufacturers and waning consumer enthusiasm for EVs. Despite these challenges, there are some positive signs for NIO. The Chinese government is introducing new stimulus policies to boost demand for EVs, which should benefit NIO. Additionally, NIO's battery-as-a-service model has been gaining traction, cutting costs by 25% and more than doubling its subscriber base. This could help boost sales as more customers opt for NIO EVs to take advantage of the service. However, it's important to note that NIO is not expected to become profitable before 2027 and is likely to turn net cash negative by 2025. This makes the stock a risky investment. While JP Morgan's upgrade might suggest a short-term upside, the long-term outlook remains uncertain. The stock's technical chart shows a dramatic decline from its peak of $67 in 2021 to around $5.30 now. It is hovering above a crucial support level of $1.57, its lowest point in 2019. NIO has remained below all its moving averages and has formed a falling wedge pattern, typically considered a bullish signal. This suggests the potential for a price surge if market conditions improve. So, while NIO is facing significant challenges, there's still potential for a strong comeback. The Chinese government's new stimulus policies for EVs could provide a much-needed boost. NIO's battery-as-a-service model is gaining popularity, doubling its subscriber base and cutting costs by 25%. However, with the company not expected to turn a profit before 2027 and facing a high cash burn rate, caution is warranted. Ultimately, NIO's ability to leverage government support and capitalize on its innovative business model will be crucial. The road ahead is tough, but not impossible. Do you think NIO has what it takes to turn things around? Share your thoughts in the comments section below. If you enjoyed this video, you may also like our hand-picked, action-packed newsletter about NIO. Subscribe now at wiseinvesting.com. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about NIO stock, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.